by tonight, we shall conclude on asset replacement decision. Last week, we started the topic asset replacement. What this topic is all about is what is the appropriate time that we should replace company's assets. Of course, every company requires assets to achieve its business objectives. For example, the plants and machinery. The plant that we use for production, as you will basis, the machine will depreciate here. The technical life of an asset is the period of time between when the asset is purchased and when the asset breaks down beyond repair, or where repair is no longer economical. At this point, management must decide on how to replace the assets. If you don't replace your depreciated assets, that will affect ability to make production. Imagine machines that have been working for 20 years. The production efficiency of the machine will reduce. Reduction in production efficiency will affect the quality and quantity of the product produced. And that can affect the earnings capacity of the business. So we must determine the appropriate time that the asset should be replaced. Last week, there are two types of replacement. Identical asset replacement, whereby an existing asset is replaced with a similar identical asset. Two assets produce the same cash flows. We explained this last week. We explained that for identical replacement, the problem is not when to replace the existing assets, but how frequently the asset should be replaced. Just 1 minute. So if you are dealing with identical replacement, the problem we are trying to address is how frequently the asset should be replaced. To address this problem, the method to use will depend on whether you are giving cost of capital in the question or where cost of capital is not involved. If cost of capital is not involved, If there is no cost of capital, then you are going to use the average cost method. You are going to use the average cost method. Your average cost is total cost divided by number of periods. Alternatively, where cost of capital is involved, you are going to use annual equivalent value or annual equivalent cost. Annual equivalent cost is calculated as present value of cost divided by the cumulative discount factor. Your cumulative discount factor is your annuity factor. Alternatively, you can use annual equivalent value calculated as the net present value divided by the cumulative discount factor. We explained this last week. We equally explained non-identical asset replacement. Non-identical asset replacement is a situation where an existing asset is replaced by a new and technically superior asset. We go on with the class. What can we do? The weather has been very very heavy with rain. We can only hope to have a good connectivity. For non-identical, two assets are said to be non-identical when they produce different cash flows. The optimal decision is when to replace the existing asset with a new superior asset. We now explain the procedures for non-identical assets. You have 3 steps. Step 1 is calculate the annual equivalent cost of the new asset. Step 2, consider each alternative replacement option by comparing the calculated annual equivalent cost with the relevant cash flow of the old asset. Whenever the old asset is used. Step number 3, our decision criterion. The options, select the option that gives the least cost or the maximum value. You are going to select that option that gives you the least cost or the maximum value. We explained this last week. We now solve two questions. Last week we solved two questions. We did question number 2 and question number 4. The two questions we solved last week. Identical replacement question. So tonight we shall start with question number 3. Please, let's move on with the class. Can we confirm we are on that page? Are we good to go with question?
Yes, sir.
All right, Madam Roots. Adala Base Limited is reviewing its budget for the period December 31st, 2011 to 31st December 2015. The company is concerned with the existing machine, which has the following data. That should be data. The following data for next 5 years. We have year 2011 to year 2015. The existing machine has the following data. We are giving depreciation of the existing machine, supervisor expenses, power expenses, insurance, consumables, maintenance, labor, parts, and fixed overhead costs. All this information is related to the existing machine. Next, the charge for insurance is in respect of a policy which specifically relates to the old machine. The supervisor only spend a portion of his time with the old machine. The old machine is currently, that is December 2010, valued at 750,000. Although this figure is expected to fall by 250,000 each year. Next paragraph. A new machine has come onto the market, which is being offered at 3.5 million. As sales promotion idea, the company selling the machine, the company selling the new machine has promised that its next 100 customers may pay the same price. The running cost of the new machine are stated below. Labor, parts, other direct costs, fixed overhead. The scrap value of the new machine is estimated to be 2 million at the end of year one. The end of its first year. 1.5 million after year two. After 2 years. 1 million after 3 years. 250,000 after 4 years. From then on, the assets will have a negligible scrap value. You are required to determine how often the new machine should be replaced. How often should we replace the new machine? Requirement A is about the new machine. If I buy the new machine, how often should I replace this machine? Should I replace every 1 year, or every 2 years, or every 3 years? What is the frequency of replacement? Examiner says the cost of capital is 10%. To answer requirement A, requirement A is identical replacement. We are going to buy a new machine, and we are going to replace it with the same machine. How often should we replace the new machine? Cost of capital is involved. In this case, we are going to use annual equivalent cost. The machine is for 5 years. Look at it. The scrap value after year 1, 2 million. After year 2, 1.5. After year 3, 1 million. After year 4, 250. From then on, the scrap value becomes negligible. That means after year 5, the scrap value is 0. So the question is, how often should we replace the new machine? We can now go to computation. I want to calculate the annual equivalent cost of the new machine. What are the relevant cash flow? Initial cost of the machine, maintenance cost of the machine, and the scrap. What are the relevant cash flow? Initial cost of the machine, maintenance cost of the machine, and the scrap value of the machine. Because cost of capital is involved, we need to get the present value. Working one, present value of relevant maintenance cost of new machine. If you look at the question, look at the running cost of the new machine are expected to be labor cost. Labor cost is relevant. Cost of square parts. Machine part is relevant. Other direct costs. Direct costs are those costs that can be traced to the machine, to new machine. Other direct cost is relevant. Fixed overhead absorbed. Fixed absorbed overhead is not relevant. So you are going to pick labor cost, parts cost, and other direct costs. That will represent the relevant cost of the new machine. Let us move to working one. Please sum up. Labor cost 300 plus 200 plus 500. This will give me 1,000. For year 2011, that is year one. Year 2012, please sum up. 475.
1375.
1375. For year three, please sum up. You can unmute.
1750.
1750.
1750. For year 4, year 5, please sum up.
2000.
Oh, this is 2000.
The 1600.
23.
2300. You have gotten the relevant cost from year 1 to year 5. This cost will happen at different times. Year 1, year 2, year 3, year 4, year 5. Because cost of capital is involved, we need to design this cost to their present value. The cost of capital is 10%. Our discount rate is 10%. For year 1, 10% will give you 0.909. Discount factor for year 2, 0.826. For year 3, 0.751. For year 4, 0.683. Year 5, uncle. Am I correct? I'm not sure. Please check.
0.621.
21, right?
621.
Yes, sir.
Now you can now get the present value. Cost multiplied by the discount factor. 1,000 multiplied by 909. That will give me
909.
909. 1,350 multiplied by the discount factor.
1136.
1136.
1186. Next.
1314.
1314. 14. Next.
1366.
1366. Next.
1428.
1428. No, 28.
Yes, sir.
Yes, sir. That year 2 is
So the year
113.
1136.
Year what?
Year 2.
Year 2.
113.
8.
6.
Sorry, 36.
We have brought the cost to their present value. That is your working one. Remember, we mentioned 3 relevant cash flows. Cost of the machine, maintenance cost of the machine, and the scrap value. Working 2. No, not this. Working 2. The scrap value. Working 2. We have year 2011, that is year 1. Scrap value is 2 million. Assuming 30 up. Year 2012, that is year 2. Scrap value is 1.5 million. Year 2013, that is year 3. Scrap value is 1 million. Year 2014, that is year 4. Scrap value is 250,000. Year 2015, that is year 5. Examiner says scrap value becomes negligible. That is 0. The scrap value is at different time. Now I need to take it to their present value. Introduce your discount factor at 10%. This is 0.909, 0.826, 0.751, 0.683, 0.621. We now get the present value. The present value of your scrap value. 0.909. 0.09 multiplied by 2,000. So it gives me
1818.
1818.
1818. Next.
1239.
1239. Next.
751.
751. Next.
171.
171. We can now go to our options now. Look at the option. Replace every 1 year or 2 years or 3 years or 4 years or 5 years. Initial cost of the asset. That is 3.5 million. That's in brackets. 30 up. 30 up. 30 up. 30 up. 30 up. Running cost for year one, the present value. We purchase the asset in year 0. We are going to use for year one, maintenance cost 0.9909. The present value. The maintenance cost for year one, 909. Assuming we want to replace, okay? Assuming I want to replace after year one, I'm going to buy the assets. That will cost me 3.5 million. I'm going to use it for 1 year. I will incur maintenance cost. The present value of my maintenance cost is 909. After year one, I can sell the machine. If I sell the machine after year one, the scrap value is 2,000 naira. The present value of the scrap value, 1818. Look at it, please. I'll come here. If I want to replace after 1 year, no maintenance cost in year 2, no maintenance cost here, no maintenance cost here, no cost here. I will now come here. The present value of my scrap value, 1818. Look at option 1. I can replace after 1 year. I'm going to buy the asset year 0. I will incur running cost in year 1. The running cost is 1,000 for year 1. I will now look for the present value of that 1,000. That gave me 909. After year 1, I'm going to sell the machine at a scrap value of 2 million. That money will come in year 1. The present value of scrap value is 1818. You can now get present value of cost. For year 1, look at it. 3,000 negative plus 909 plus 1818. That will give you the present value of cost. If the asset is replaced after 1 year, then we will not get to year 2. Look at it again. $3,500. Look at it. 3,500. 909. As 1818. That will give you 2,591. That is the present value of cost. 2,591. If the asset is replaced after 1 year, second option, replace every 2 years. For me to replace after 2 years, I'm going to buy the assets in year 0. at a cost of 3,500. Is that not? I'm going to incur year one maintenance cost. That gave me at a present value of 909. I will incur year two maintenance cost. What is year two maintenance cost? Present value 1136. I will incur year two maintenance cost 1136. After 2 years, I'm going to scrap the assets. What is the scrap value for year two?
1239.
Of course, we are going to scrap for 1,500. That will happen in year two. What is the present value? 1239. You pick that year. 1239. Now get present value of cost for year two. 3,500 negative plus 909 negative plus 1136 negative. What do you have, please? 3,005.
4306 negative.
4306 negative. Now, you now have a positive sign. The scrap value will generate money for you. Scrap value, present value, 1239. That's plus. Your final answer.
I already included the present value. Everything is
Oh, you have
430.
added this.
Yes, sir.
4306.
306.
Oh, thank you. That's the present value of cost. If that asset is replaced after 2 years, you now go to after 3 years. Look at the flow. For me to replace after 3 years, I must buy the asset first. Year 0, the asset is 3,500. If I want to use it for 3 years, I will incur year one maintenance cost. Pick the present value. I will incur year two maintenance cost, 1136. I will also incur year three maintenance cost. The present value, 1314. After year 3, I'm going to sell the machine to realize 1 million. I will now look for the present value of 1 million. That gave me 751. Now get the present value of cost for year 3. It 3,500 negative.
6108 negative.
You have removed the positive, right?
Yes, sir.
There's a positive of 71 here.
Yes,
751.
yes.
Oh, that's great. That will give me what?
6108.
6108 negative. We now move to year 4. If I want to replace after 4 years, I must buy the assets first. That will cost me 3.5 million. I'm going to incur year 1 running cost, 909. We are taking present value because cost of capital is involved. I'm going to incur year 2 running cost, 1136. I'm going to incur year 3 running cost, 1343. Then I will incur year 4 running cost, 1366. The scrap value for year 4, present value, 171. Year 4 running cost, 1366. Then we are going to scrap the machine for 250 with a present value of 171. What is the present value of cost?
8054 negative.
What do you have?
8054 negative.
8054
054
negative. We now move to year 5. If I want to replace after 5 years, I must buy the asset first. That will cost me 3.5 million. I will maintain for year 1 with the present value of 909. I will maintain for year 2, 1136. I will maintain for year 3, 1314. I will maintain for year 4, 1366. Then I will need to maintain it for year 5, 1428. The scrap value is 0. Please sum all the costs.
9653 negative.
9653 negative. You have gotten present value of cost. You have gotten your present value of cost. We now introduce our cumulative discount factor. Cumulative discount factor is also known as annuity factor. Come here. Discount factor for year 1, 0.909. I'll pick that. 0.909. Cumulative for year 2. You are going to add 0.909 plus 0.826. That will be for 2 years. Year 1 discount factor plus year 2 discount factor.
1.735.
1.735. For year 3, add 1.735 plus 0.751. That will give you for 3 years.
2.486.
0.486. For year 4, add 2.486 plus 0.683.
3.169.
For year 5, 3.169 plus 0.621.
3.79.
3.79. Zero. You have gotten your cumulative factor. Remember the formula for annual equivalent cost. Remember the formula for annual equivalent cost. Let us show the formula here so as to guide our computation. Annual equivalent cost is equal to present value of cost divided by the cumulative discount factor. In other words, you can get your annual equivalent cost 2,591 divided by 0.909. What do we have, please? You can ignore the minus. When we say cost, you already know it's in brackets. You can ignore the brackets. Pick 2,591 divided by 0.90. 0.909. What do you have?
2,850.
Can't get you.
2,850.
2,850. Move to year 2. 4,306 divided by 1.735.
2,481.
2,481. Move to year 3. 6,108 divided by 2.486.
2457.
2457. Move to year 4 and year 5. Do the same thing.
2541.
2541. Then for year 5,
2547.
25.
47.
The way network na log
2547.
Yes.
Monica Cartoon.
All right. Now your final decision. You are going to look at for the 5 option where you have the least annual equivalent cost, where your cost is at minimum. That option, if you compare, that option that will give you the minimum is in year 3, 2004-57. So your decision, the new machine should be replaced every 3 years with annual equivalent cost of 2,457,000. You have answered requirement A. Our new machine should be replaced every 3 years with an annual equivalent cost of 2,457,000. You are done with requirement A. Yes, you can ask your question.
Okay, sir. I'm having a network fluctuation before. What is the yardstick or criteria for this decision of taking year 3 as our the year that the assets should be replaced?
All right, compare the annual equivalent cost from year 1 to year 5, where you have the minimum cost, where your cost is reduced. As a rational business person, you are going to take that decision that minimizes your cost or maximizes your value. As a rational business person, you are going to look at that option that minimizes your cost or maximizes your value. For this question, we are only giving the cost of machine. Revenue is not involved. For this question, we are only giving the cost, running cost of the machine. So the rationale or the yardstick for picking year 3 is because our annual equivalent cost is at minimum. Is that better, sir?
Thank you, sir.
We have addressed a part of the question. We have agreed that new machines should be replaced every 3 years. Now the B part is, when should we replace the old machine with the new machine? Requirement B now. We are going to buy a new machine. But the question is, currently we have an existing machine. When should we replace the existing machine with a new machine? Determine when the old machine should be replaced. This is non-identical replacement. Let's go back to the question. Abiola Base is reviewing its budget for the period 2021 to 2025. The company is concerned with the existing machine, which has the following data for the next 5 years. Look at the data. Examiner says the charge for insurance is in respect of a policy which specifically relates to the old machine. Supervisor only spends a portion of his time with the old machine. The old machine currently, year 2010, the old machine is currently valued at 750. As at now, the machine worth 750. Although this figure is expected to fall by 250 each year. So, what are the options? Remember, you have said new machine must be replaced every 3 years. What are the options here? For old machine, you can replace now. For old machine, let's go to old machine. Okay. Let me explain this. Relevant cost of old machine. Relevant cost of old existing machine. Let's go to it. How we pick the relevant cost. Depreciation is not a relevant cash flow. It's not even a cash flow because depreciation is an accounting convention. So you are going to disregard depreciation. Supervisor salary. Examiner says supervisor only spends, look at it, the supervisor only spends a portion of his time with old machine. That means the supervisor has other work. Whether it comes to the old machine or not, you are going to pay supervisor his salary. Hence, supervisor salary is not relevant. He supervises many machines. So it's on salary payments. Supervisory salary is not relevant. We disregard that. Power is relevant. That is electricity power consumed as a result of using the old machine. Insurance. Examiner said this insurance is specifically related to old machine, hence is relevant. Consumables of using the old machines, relevance. Labor is relevant, part is relevant. Fixed overhead absorbed is not relevant. So you are going to disregard 1, 2, 3. These 3 items are not relevant. Let us look at the relevant cost of new machine, of old machine. Please sum up. 15 plus 5 plus 130 plus 800 plus 550. Please sum up.
$1,300.
1,300. Year 2, please sum up. 1, 2, 3, 4, 5. Oh yeah.
That 2011 is 1.5.
1,500.
Year
Next.
2,000.
Year 2.
2,000. Year 3, 2,500.
Year 3,
2,500.
2,500. You observe that we ignore year 2014 and 15 because after year 2013, the old asset scrap value has become 0. You are going to see now the discount factor at 10%, 0.909, 0.826, 0.751. Why we are taking present value is because cost of capital is involved. Discount to their present value. 1,500 multiplied by 0.909.
1,364.
1,364. Next.
1,652.
1,652. Next.
1,878.
1,878. All right, let's now go to the options. Option 1. Replace the old machine now. Replace the old machine now. Now is 31st December 2010. Replace now. If you are replacing now, what are the relevant cash flow? That is year 0. What is the value of the old machine now? Look at it. The old machine is currently valued at 750,000. That means if you replace now, we can sell the old machine for 750. We are going to realize 750 now. We are going to realize value of old machine. We are going to realize 750,000. That is the cash flow. The discount factor, year 0 is 1. As soon as you replace the old machine, that means we must bring in the new machine. Remember the rules. Let me take you to that side. Look at the rules. For non-identical, look at the steps. Look at this. A, calculate the annual equivalent cost of the new asset. We have done that. We have calculated the annual equivalent cost. B, consider each alternative replacement option by comparing the calculated annual equivalent cost with the relevant cash flow of the old asset. Whenever the old asset is used, that is step 2. We are dealing with step 2 now. So I can replace now. If you replace now, we now introduce the new assets. We have the new assets. Look at it. From year 1 to year 3, annual equivalent cost of new assets, 2,457,000. Annual equivalent cost of new assets, year 1 to year 3. Don't forget, the new asset must be replaced after 3 years. So we are going to incur Annual equivalent cost for year 1, year 2, year 3. These are the relevant cash flow. If you replace now, we are going to sell the assets to get 750 now. We are going to introduce the new assets. We are going to incur annual equivalent cost from year 1 to year 3. We now look for year 1 to year 3. Cumulative discount factor 2.486. We have done it before. Cumulative for 3 years. These are the relevant cash flow. If the old asset is replaced now, we are going to sell the asset in year 0 to realize 750. Then we are going to introduce new assets. The new assets annual equivalent cost is 2,457,000. And that will be for 3 years. Because after 3 years, we are going to replace the new asset again. We now look for their present value. 750 multiplied by 1. That will give me 750,000. 2.486 multiplied by this amount. 2,457,000.
6108.
6108.
102.
Which one are you giving me? 108 or 102?
6108. 102. That's 6 million.
Oh, 6108.
102.
Thank you. Now get the present value.
5358. 102. 5358. No, 5358. 102.
102.
Yes.
Thank you, sir. Let me bring it out very well. 5358. 102. Negative 5358. 102. This is the present value of the first option. If you replace now, option 2. Option 2. Replace old machine after 1 year. That means we are not going to sell again now. Look at it. The year 1. We are going to use the old asset for 1 more year. We are going to incur running costs. What is the running cost of the old assets? Look at the old assets. After 1 year, we are going to incur relevant running costs of 1,500 with a present value of 1,364. We'll pick that. Don't forget we have 30 up. We are going to incur 1,364,000. Present value of our running cost. Year 1. After year 1, we are going to sell, again, after year 1, we are going to sell the old assets. What is the scrap value after year 1? What is the scrap value of the old assets?
500,000 naira.
Thank you. Let's go and show it to ourselves. Because if you don't show it, examiner says the old machine is currently valued 750. Although this figure is expected to fall by how much? 250. That means after 1 year, 750 will fall by 250. The value becomes 500. After 1 year, we can sell the old assets to get 500. We now introduce our new assets. That means the new asset now, we run from year 2 to year 3. You know, we have 3 years. We have retained the old asset for 1 year. That means year 2 to year 3, we are going to incur annual equivalent cost of new assets, 2,457,000. Because we are going to use the old assets for 1 year first. Out of the 3 years, we have used 1 year for the old asset. Remaining 2 years is from year 2 to year 3. We are going to incur 2,000,000. These are the relevant cash flow. If this asset is used for 1 year, if the old asset is used for 1 year, you are going to incur relevant cost of the old assets, the scrap value of the old assets, then annual equivalent cost of the new assets. But the years has reduced because we have used the first year for the old asset. That means year 2 and year 3 is for our annual equivalent cost. Now come here, introduce your discount factor at 10%. For year 1, this is 0.909. Year 1 scrap value 0.909. Year 2 and year 3, you can come here. Discount factor for year 2 and year 3, please add 0.85. No, you are now picking year 2 and year 3. So the discount factor for the year 2 and year 3.
$1.577.
0.826 plus 0.571. That will give me 1.577. $1.577. That is how you are going to treat non-identical replacement. Present value. Multiply 2475000. This will give me 3874,689. Next, 0.909 multiplied by 500. Positive 500. Next, 136400 multiplied by 0.909. I have negative 1,239,876. The final answer.
4,660,065.
065. This is let's continue. That is option 2. Option 3. Replace old machine after 2 years. 2 years. You have your year 1, year 2. Year 2 again. Or I can do it, okay. If I want to replace old machine after 2 years, that means I'm going to use it for year 1. I will use it for year 2. After year 2, I'm going to sell the old asset. I will now introduce the new asset. Look at it. Running cost of old machine. Running cost of old machine. Wait. There's a mistake here. We have already done the present value now. Look at this. We have done the present value before. I need to correct this quickly. Running cost for year 1 should be 1.5 million with a present value of 1.3. We have done that before now. 1,364,000. That will affect my computation here. I need to check this back. 1,364,000. Or let me check. 1,500 multiplied by 0.909. Okay, this gave me plus 3,874,689 minus 454,500. The figure here should be 47,836,89 because you cannot discount 2 times now. So look at it again. If you want to replace after 2 years, you are going to incur running cost of 1.5 million in year 1. Running cost of old machine in year 2. That will give me 2 million. That will give us 2 million. After year 2, we are going to sell the asset. The scrap value. Examiners say old machine currently worth 750. And it will reduce by 250 each year. That means after year 2, from 500,000, the value will move towards how much?
250,000.
These are the relevant cost of old machine. We are going to retain it for 2 years. That means we are going to maintain in year 1, year 2. We are going to sell it in year 2. We now introduce the new asset. That will happen in year 3 at an annual equivalent cost of 2,457,000. In brackets, we now introduce our discount factor. For year 1 is 0.909, year 2 0.826. This is year 2 0.826. Year 3 equivalent cost 0.751. We now get the present value. This will give us 1,500 multiplied by 0.090 This give me 1,363,500 by 2 million. This gives us 1,652,000. 250,000 multiplied by 0.826. That's scrap value positive. 206,500. 2,457,000 multiplied by 0.751. That will give us 07. Now get the present value of cost. Plus 1.
Four 654 207.
All right, thank you, sir. Yeah, that's correct. 4, 6, 5, 4, 207. That is the present value of that cost. Then option 3, replace after 3 years. That should be option 4. Option 4, Abby. Replace old machine after 3 years. That means we are going to use the old machine for 3 years. You have your year 1, year 2, year 3. We are going to incur running cost. The running cost of old machine in year 1, that is 1,500,000. Running cost of old machine for year 2, 2 million. Running cost of old machine for year 3, 2.5 million. After year 3, the machine scrap value is 0. 250 less. In year 2, it was 250. 250 minus 250, that is nil. Whether we like it or not, we must replace this machine after 3 years. We can't bring it anywhere, but it has completed 3 years. By force, after year 3, new machine must come on board. You now bring in, this is your cash flow, your discount factor, 0.909. That will give us 1,363,500. 0.826. That will give us 1,652,000. 1,652,000. Then for year 3, you observe that our annual equivalent cost for new machines replaced after 3 years. That means these 3 years have been completed. 2.5 million multiplied by 0.751.
$1,877,500.
Negative 100. Because the old machine has been used for 3 years.
Final answer 4893.
4893
000.
000. Now, here the 4 options where you have the least cost. The first one is like 5.3 million cost. The second one, we have like 4.78 million. The third option we have 4.65 million. The last option we have 4.89. Our least cost is option 3. That is replace this is the option. Our decision. Our decision. Decision. The old machine should be replaced with a new machine after 2 years of use. This is because the option minimizes the relevant cost of replacement. That option minimizes the relevant cost of replacement. Wow. We are done with question 3. Any question, please? Yes, any question? Any clarification? I hope some of us are not sleeping in class. I hope some of us are not sleeping in class. Where's
No,
Priska?
sir.
We are not sleeping, sir. We are following you.
Okay. Where's Priska? Priska is not in class. Okay. Rose is in class. Okay. All right. Even me, I'm even tired. But I need to finish the topic today. The question we have solved so far, I believe is sufficient. We have solved 3 questions. But all the questions, taxation is not involved. So I'm going to just take question 1 to explain how to treat your taxation. You know, at times, if you buy an asset, you enjoy tax capital allowance on the asset. So I'm going to use question 1 to explain how to deal with taxation. Look at question 1. Some are having connectivity problem. Jamil cannot be in class. I'm sure it's because of the connections. It's even raining my side self.
I'm in class since, sir.
Okay, sorry, sir.
Though it has been raining since morning in Delta State too, but
Even
network
Lagos
is
State.
okay. Alonso.
Let's look at question 1. Please, if you are sleeping, just try to wake up. These 30 minutes, let us have it together. Kuku PSC had a need for a machine. After 4 years of purchase, the machine will no more be capable of efficient working at the level of use by the company. Meanwhile, it has been the company's practice to replace machines every 4 years. The production manager has pointed out that in the 4th year, the machine will need additional maintenance to keep it working at normal efficiency. The question has therefore arisen as to whether the machine should be replaced after 3 years instead of 4 years. In line with the company's practice. So the question is, should we replace after 3 years or after 4 years. That means we have two options. Relevant information is as follows. A new machine will cost 240,000 naira. If the machine is retained for 4 years, it will have a zero scrap value at the end of the period. If it is retained for 3 years, it will have an estimated disposal value of 30,000 naira. The machine will attract capital allowance of 20%, reducing balance tax allowance in the year of being owned by the company. You are going to claim allowance, capital allowance in the year of ownership, except the last year. In the last year, the difference between the machine written down value for tax purposes and its disposal proceeds will be allowed to the company as additional tax relief if disposal proceeds are less than the tax written down value. It is assumed that the machine will be bought and disposed of on the last day of the company's accounting year. Note number 2, the company tax rate is 30% and tax is payable on the last day of the accounting year concerned. Note number 3, during the first year of ownership, the supplier takes responsibility for any necessary maintenance work. In the second and third year, maintenance cost average 30,000 naira a year. During the fourth year, maintenance costs will rise to 60,000 naira. Maintenance charges are payable on the first day of the company's accounting year and are allowable for tax. Please note that statement. Maintenance costs are payable on the first day of the year and are allowable for tax purposes. The company's cost of capital is estimated at 15%. Requirements. You are required to prepare calculations to show whether it will be economically beneficial to replace the machine after 3 years or 4 years. So we have two options. Should we replace the machine after 3 years or after 4 years? What are the relevant cash flows? Let's go to it. First, replace after 3 years. Of course, we have to buy the machine. The machine will cost, that will be in year 0. We are going to buy the machine for 240,000 naira. Now, capital allowance. If I buy the machine, I'm going to incur 240,000. I need to claim capital allowance. Now come to the workings. Our capital allowance. Cost of the machine, 240,000. This is year 0. You are going to claim the allowance in year 0. Examiner say capital allowance is claimable in the year of ownership. Capital allowance, this is 20%. Please compute 20% of 240. Most of us are sleeping now.
$48,000.
Okay, 48,000. That is multiplied by 2.0. 48,000. The difference is I'm not saying reducing balance. That will give you written, tax written down value. Tax written down value. Please, the difference. 240 minus
192.
that give me how much?
192,000.
192. $192,000. Again, compute capital allowance for year 1 at 20%. 20% of 192.
38,400.
38,400. Again,
153,600.
192 minus 38,400.
153,600.
Put capital allowance for years. $37,20. Then get capital allowance for year 3. Get tax written down value. $153,600. That will give me
122,880.
we now go to year 3. Year 3. If the machine is replaced after year 3, if the machine is disposed after year 3, we need to get, we are not going to compute capital allowance. We now introduce the disposal proceed. Disposal proceed. The machine can be disposed. Look at it. Year 3. We can sell the machine for 30,000 naira. The proceed is 30,000. Compare the two. The tax written down value is 122,800. And you are selling the assets for 30,000. That means we have incurred loss on disposal. An asset that was 122,880 is sold for 30,000 naira. That means we have incurred loss on disposal. And that is what we call balancing allowance. The difference between these two. What is the balancing allowance?
92,800.
92.
800.
80.
880, sorry.
That is what we call balancing allowance. We can stop here. Assuming we are selling in year 3. Now compute what is the implication of capital allowance? Capital allowance is to reduce your tax expense. Capital allowance is to reduce your tax liability. When you are done computing the capital allowance, now calculate what we call tax relief, tax savings. To compute that, pick the tax rate, 30% of 48,000. That is the tax savings for the year 0. $48,000 multiplied by 30%. That will give me 14,400. For year 1, capital 5 points. For year 2, the capital allowance is 3720 multiplied by tax rate. That will give me 9216. For year 3, the total allowance, balancing allowance, 92,880 multiplied by the tax rate. That will give us 27,864. That is the tax relief if the machine is replaced after 3 years. Now come here. The tax allowance here, savings. Tax savings is an inflow, 14,400. $11,520, 9216. 11,520, 9216.
27,864.
27,864.
27,864. This calculation we assume that the asset will be replaced after 3 years. That means we are going to sell the asset after 3 years. If you are to talk of replacement after 4 years, that means when you get to this portion, look at it. This will still apply here. This will still apply here. This will still apply here. When you now get to this year, since we are going to sell in year 4, you are not going to stop here. You now come here and say, or after 4 years. In this case, you are going to pick the tax written down value. Tax written down value 122880. You now come to year 3. Year 3, capital allowance at 20%. Because we are looking at replacement after 4 years. That means we are not going to sell the machine at the end of year 3. So if you are not selling at the end of year 3, you are going to put capital allowance for year 3. That will the capital allowance here becomes 24,576. Therefore, the tax written down value our tax written down value here is 98,304. We now go to year 4. The disposal value will be 0. Year 4, disposal proceed is 0. That means in year 4, we are going to get balancing allowance. $98,304. Therefore, if you are looking at option 2, in year 3, let me check the pen here. In year 3, we are going to claim tax savings on capital allowance. The capital allowance is 24,576 multiplied by 0.3. We are going to claim 7,373. Year 4, we are going to claim 98,304 multiplied by 30% tax rate. We are going to claim 29 If you get to option 2, you are going to pick, look at option 2. Tax savings here, 14,400, 11,520, 9,216. Here I'm going to have 7,373. Then I'm going to have 29,491. We are trying to prepare ahead. The asset will cost 240,000. All right, we have resolved capital allowance. That is the tax savings. That capital allowance determine the tax savings on the allowance. That will reduce your tax liability. You can now come here. Maintenance cost. Examiners say the supplier is responsible for the first year maintenance cost. Examiner says the supplier takes responsibility. Look at note number 3. During the first year of ownership, the suppliers take responsibility for any necessary maintenance work. In year 2 and year 3, maintenance costs average 30,000 naira a year. During year 4, maintenance cost will be 60,000 naira. Maintenance charges are payable on the first day of the accounting year. That means maintenance cost for year 2 is paid at the beginning of year 2. Under investment appraisal, beginning of year 2 implies end of year 1. That means the maintenance cost for year. That cost is incurred at the start of year 2. Under investment appraisal, start of year 2 implies end of year 1. Maintenance 30,000 naira incurred at the start of year 3. Under investment appraisal, the beginning of year 3 implies end of year 2. That means this will come here. This project is for 3 years. We are going to incur maintenance costs for year 1. Year 1 maintenance cost is to be taken or to be financed by the supplier. Year 2 and year 3, 30,000, 30,000. But at the beginning of each year, this machine, we are assuming that we are going to use this machine for 3 years. That means we cannot bring in year 4 maintenance cost. We now calculate tax savings. Examiner says the maintenance cost is liable for tax. That means Maintenance cost for year 2. The cost is incurred at the beginning of year 2. Under the tax rule, that cost is incurred in year 2. Under the tax rule is different from investment rule. That cost is incurred in year 2. So compute the tax relief. 30% of 30,000. That will give you 9,000. That is the tax relief for year 2. The tax relief for year 3. That maintenance cost was incurred at the beginning of year 3. And the tax relief will happen in year 3. 9,000. Look at it. Investment rule is different from tax rule. Then the scrap value. The machine can be scrapped at the end of year 3 to realize 30,000. You can now get the net cash flow $240 minus $240 minus 14,400. That will give me negative 225,600. Oh, why is it running so much now? $225,400 negative. For year 1, $1,150 minus 30,000. That will give you negative 18,480. For year 2, 9,216 plus 9,000 minus 30. That will give you negative 11,784. For year 3, $27,864 plus 9 plus 30. That will give us 66,864. You now introduce your discount factor at 15%. Here we have 0.8696. No, this should be year 0. This is year 1, 0.8696. This is year 0. This will give me 1.7 7561. Year 3, 0.6576. Get the present value of cost. 225,400. 0.8696 multiplied by 18,400. Here I have negative 16. Next, 11,784 multiplied by 0.7561. Here I have negative 8910. The last one, multiply by 0.6575. 43,963. You can now get value of cost. Here we have present value of cost. $206,346.92.
So,
Yes, Rose.
for the second year is 16,070.208. They say that's approximately 16.070, not 16,000.
18,480 multiplied by 0.8696. Okay, we have 0 there. Okay, thank you. So you should have 0.07. So that will do total cost. I just come here, 206.
$416.92.
Final answer.
416.92.
Okay, 416.
26417 approximately.
Four one six 416.9. That is the present value of cost if you replace after 3 years. If you now go to after 4 years, to be faster now, let me take just like 5 minutes. Yes, any question, Rose?
No, no.
Maintenance cost for year. Maintenance cost for year 1. Ordinarily, that maintenance cost is to be financed by the supplier. Maintenance cost for year 2 is 30,000. Examiner says this maintenance cost will be provided or will be incurred at the start of year 2. Start of year 2 means end of year 1. So you are going to bring 30,000 here. This is the maintenance cost for year 2. Maintenance cost for year 3 at the start of year 3. Start of year 3 under investment rule refer to end of year 2. Maintenance cost for year 4 because we plan to we are looking at replacement for it. Maintenance cost for year 4 is 60,000 to be incurred at the start of year 4. Start of year 4 under investment is end of year 3. We now go to the tax relief. The tax relief for year 2. That maintenance cost will be incurred in year 2, 30,000 naira. 30% of 30,000. The relief is 9,000. For year 3, the maintenance cost is 30,000 to be incurred at the beginning of year 3. Under tax rule, that cost is incurred in year 3, and the relief will be claimed in year 3, 30% of 30,000. That's 9,000. Maintenance cost for year 4, 60,000, incurred at the start of year 4. The relief is 30% of 60. That is 18,000. For this option, there is no scrap value. If the asset is replaced after year 4, there is no scrap value involved. That means the scrap value is nil. Now get your net cash flow. This will give us 225,400. Abi? Is 225,400 negative. Next, 11,520 minus 30,000. 18,480 negative. Next, 9,216 plus 9,000 minus 30,000. 11,784. Next, 7,373 plus 9,000 minus 60,000. Negative 43,627. Then last 29,91 plus 18. 47,491. $47,491. Now get the present value. This is year 1. So this is 1, 0.8696, 756 what? 61 0.657 5 0.6575 4 0.5718. Our present value 225400 negative, 16070 negative. So it give me 8910 negative. Oh, don't run too much. 8910 negative. 43,627 multiplied by 0.6575. That will give me negative 28685. The last one, 0.718 multiplied by 47,491. 27,155. Get the present value of 27,155 minus 28,685 minus 8901 minus 16,070 minus 225 400. That will give you the present value of cost here. $251,910. To round up, we now look for the annual equivalent cost. You are going to divide the present value by the annuity factor. We can shift this more. Sorry for taking your time, but it doesn't worth coming to this next week. It does not worth coming to this next week. It's still wasting time. Let's go on. We come here, we have the option after 3 years or 4 years. can now come here. I need to move this up. System is hanging new. You have present value of cost. Here I have two words here, self. Is even hanging, not allowing me to go up. Okay, it's back now. Let me pick this guy. It's not allowing me to move. So, can't be going like that. The cost here is what? 206. The first one is 206. 206. 416. .92. Can come here. I won't be able to clean it. Call. Except if I do like this. Wait, let me erase it from here. Erase. It's not allowing me to move. Okay. You can go now. Let me pick this. Present value of cost now. I have 3 years or 4 years. The present value here of cost 206 416.92. For the second option, 251910, 251910. Introduce the annuity factor or cumulative factor, 15%. Annuity factor for 3 years. 1 minus bracket 1 plus 0.15 plus 0.15 raised to power minus 3 divided by 0.15. The annuity factor here. Yeah. 2.283 for 3 years, 2.283. Annuity factor for 4 years. 1 minus 1 plus 0.2 to the power minus 4 divided by 0.15. Annuity factor here, 2.855. This is for 3 years. Replace after 3 years. Replace after 4 years. Then your annual equivalent equivalent cost. Your annual divide the present value by the annuity factor. $2.283. This will give us 90,415. Option 2, divide the present value of cost. 251,910 divided by 2.855. This will give us 88,235. You now compare the two. Which one will give you the least annual equivalent cost? Option 2 is better. The least annual equivalent cost is 88,235. Hence, the machine should be replaced after 4 years. Wow. We are done with this question. Sorry for taking your 20 minutes. Others will watch the video. Out of 20 something, we are left with 13 students. Last week we closed much earlier now. We closed earlier now. All right. May God give us a better understanding.
Amen.
Please
Amen.
Thank you,
try
sir.
to review all these things we have done. The energy we put to this is to be able to give you the best for your exam. Good night. Let's have a blessed evening.
Good night, sir.